Welcome to the Stock Market Palantir channel. Don't miss any new stock insights from us by subscribing to our channel and drop any comments below. Okay, let's get started.
$6.62. That's the number. It's where ENVX Corporation closed Friday, January 30th, 2026, down over 7%, 7.15% in a single day.
And the volume was just, it was absolutely screaming. This wasn't some quiet Friday afternoon drift. No, the spike was way above average. We are looking at a stock that has been just violently repriced, down from a 52-week high of, what, $16.49? That's a huge erasure of value.
It is. And that price action, it really sets up the only question that matters right now. Is this a fundamental breakdown? A speculative tech stock finally hitting that death valley of manufacturing? Or is this a massive market inefficiency? Are we looking at a revolutionary battery company being priced at a fire sale discount?
I'm arguing it's the former. I see a company with a brilliant slide deck colliding up head first with the brutal reality of physics and cash burn. The market is voting, and it's voting with its feet.
And I'm arguing the market is just blind. This sell-off it's about short-term sector rotation and fear. It completely ignores the engineering reality. I see a technically superior product approaching a bullish reversal in 2026. This is a real alpha opportunity for anyone willing to look past the panic on the ticker.
Well, price is truth, at least in the short term. And right now we have 34% short interest. I mean, a third of the float is betting ENVX cannot cross that chasm from R&D to mass production. But okay, let's strip away the sentiment for a second. Why do you believe this falling knife is actually a coiled spring?
Because the market is pricing ENVX like it's just another chemistry experiment, when it's actually an architectural revolution. I mean, everyone else in the battery space, your Panasonics, your Cattles, the legacy guys, they're all just tweaking chemistry. They add a little pinch of silicon dust to a graphite anode and, they call it a breakthrough. ENVX has fundamentally redesigned the mechanics of the battery itself.
You're talking about their 3D silicon lithium-ion structure?
Exactly. The architectural revolution. And look, just for a second, look at the technicals. The RSI is sitting at 33.2. We are deep in oversold territory. But then you look at who is buying while the retail guys are panic selling. UBS, they didn't just buy a few shares. They increased their position by over 255% in late January. Vanguard is up nearly 11%. BlackRock, nearly 14%. The institutions, the so-called smart money, they are loading the boat because they understand what that Fab 2 in Malaysia really represents.
Institutions hedge, and UBS buying a stake doesn't change the fact that the chart looks like a staircase going straight into a basement. I mean, since the SPAC bubble of 2021, the trend has been relentlessly down. You talk about revolution, I'm looking at the cash flow statement. In the first 9 months of 2025 alone, they burned through $68.3 million in operating cash. That is just not sustainable without massive dilution.
That burn is the cost of entry. You can't build a hardware moat with software margins. You have to build the factory.
But you have to finish building the moat before you run out of water. This is a show-me story, plain and simple. Until they can prove high-volume yields at that Malaysia plant, Fab 2, this remains a science project. A 34% short interest means the sharks smell blood in the water. They are betting that the physics of silicon expansion will break the bank long before ENVX can break the market.
Okay, let's attack that science project label right now, because that is where the whole disconnect is. If you don't understand the tech, you can't possibly understand the valuation.
Go ahead, explain how they actually plan to make money, because right now they seem to be manufacturing promises more than anything else.
They make money by solving the single biggest complaint in all of consumer electronics: battery life. And to do that, you need silicon anodes. Everyone knows this. Silicon holds way more lithium than graphite does. It's the holy grail for energy density. But there's a big catch.
It swells.
Violently, yeah. Silicon expands by about 300% when it's charged. Now think about the industry standard, the jelly roll. It's like a Swiss cake roll, You take the anode, the cathode, the separator, and you wind them all up really tight. If you put pure silicon in that structure, the expansion it crushes the internals. The battery basically pulverizes itself. It dies after just a few cycles.
So the industry just uses a sprinkle of silicon to keep things stable?
ENVX claims 100% active silicon because they threw out the Swiss roll. They use a stack. Imagine a deck of cards. They laser cut the electrodes, stack them vertically, and then, and this is the really genius part, they apply a stainless steel constraint system. It's a literal mechanical cage around the whole stack.
A corset for the battery.
Exactly. It forces the silicon to expand efficiently within the structure, and it keeps the external swelling under 2% over 500 cycles. That is how you get energy density over 900 watt-hours per liter. That is how you get a battery that lasts for days, not hours.
I will grant you the physics is elegant on paper, but here is the problem with your deck of cards analogy. Dealing cards is easy. Manufacturing that stack, you're talking about pattern, stack, constrain. This requires unbelievably high precision tools. You have to stack thousands of these layers per battery with micron-level accuracy. Doing that in a lab in Fremont is a triumph. Doing it millions of times in Malaysia with 90% yield, that's a logistical nightmare.
That complexity is the barrier to entry. If it were easy, don't you think Apple or Samsung would have done it in-house 5 years ago? ENVX isn't ignoring the difficulty. That's why they developed the pre-lithiation process. They insert extra lithium to compensate for that first cycle loss. And then there's breakflow.
The internal resistor.
It's way more than a resistor. It's a thermal fuse built right into the cell. When you pack this much energy into such a small space, thermal runaway is the enemy. Breakflow regulates the current. If a short circuit happens, it throttles it. It makes the battery inherently safer than the standard lithium-ion cells that are, burning holes in people's pockets today. So you have denser, safer, and structurally sound. That is not a science project. That is a product that OEMs are desperate for.
Desperate? Maybe, but are they exclusive? No. You're comparing ENVX to legacy players, but look at the valuation gaps in the next-gen space. Look at QuantumScape.
I was waiting for this comparison.
QuantumScape is sitting at a market cap between, $5.3 and $6.3 billion? ENVX is struggling to hold $1.5 billion. The market is saying QuantumScape's solid-state promise is worth 4 times more than ENVX's silicon stack.
And that valuation gap is the inefficiency I am screaming about. QuantumScape is selling a dream. Solid state is always years away. They have zero revenue. They require an entirely new manufacturing ecosystem that doesn't even exist yet. ENVX is, you could call it semi-solid. They use a standard liquid electrolyte. That means they can use standard supply chains. They are scaling high-volume manufacturing now. The market is paying $6 billion for a PowerPoint deck and $1.5 billion for a factory that is actually turning on.
Or the market understands that true solid state is the end game. And ENVX is just a bridge technology, a bridge that might collapse before it's even finished. And they aren't the only ones in this space. What about Amprius, silicon nanowire? Their energy density numbers are even higher than ENVX's.
Amprius is brilliant tech, I won't deny that. But it's boutique. Silicon nanowire is incredibly expensive to grow. That's why Amprius is chasing aviation and drones, markets where you will pay absolutely anything to save a few grams of weight. ENVX is targeting smartphones and wearables, the volume consumer market. You can't put a $500 battery in an iPhone. You can put an ENVX battery in one.
But that focus on the consumer market brings us right back to the factory floor. You cannot service a Samsung or an Apple launch if you can't hit the numbers. And frankly, the leadership churn at this exact moment, it's terrifying.
You're referring to Ajay Marathe.
Yes, the COO.
The guy in charge of operations retires in January 2026, right as they are entering this Death Valley ramp-up of Fab 2. I mean, when the general leaves the battlefield just as the shooting starts, I get nervous.
See, I think you are completely misreading that move. Ajay was the architect. He built the foundation. He got the fab built. Ki-hong Park is the operator. Park ran South Korean operations for the lithium-ion giants. He brings decades of big battery manufacturing rigor. This is a strategic pivot from startup scrappiness to industrial scale. It's exactly what you want to see if you're bullish on mass production.
It's a nice narrative, but It introduces friction. New leaders want to change processes. Friction kills yield. And speaking of which, let's look at the catalyst calendar. What exactly is going to stop this stock from sliding to $4?
2026 is the year of the smartphone. They plan to initiate production for mobile handsets in the first half of this year. They are engaging with the top 8 OEMs.
Engaging. Plans to. These are soft words.
Okay, then here's hard data. They delivered over 1,000 battery packs to a lead smart eyewear customer. The street knows this is almost certainly Meta. If ENVX is powering the next generation of AR/VR glasses, that is the ultimate validation. That isn't a sample, that's a pre-production run.
Rumors are not revenue, and yields are the only metric that matters. Management is targeting 90% yield by mid-2026. If they are stuck at 70% or 60%, the unit economics just collapse. They burn cash faster, they miss delivery windows, and the stock gets hammered.
You're betting against the jockey. Look at the CEO, Dr. Raj Talluri.
I know his resume.
But do you appreciate it? He ran a $7 billion mobile unit at Micron. He was at Qualcomm. He has a PhD in engineering. This isn't just a suit. This is a technical operator who knows how to scale semiconductor-style manufacturing. His employee rating is 85 out of 100. The engineers on the floor respect him because he understands the rigor. He isn't trying to defy physics. He's applying semiconductor discipline to battery making.
And even the best CEOs get crushed by capital intensity. So let's talk about that capital. You mentioned the institutional buying earlier. UBS, BlackRock, but I'm looking at the insiders, the people with the key cards to the building.
I know the stat you're going to cite.
In the last 12 months, insiders sold 144 times. They bought 38 times. That is a 4-to-1 ratio of selling. If the revolution is here, why are they all cashing out?
That is such a superficial reading of the filings. You have to look at the codes. The vast majority of that is sell to cover. They are vesting their stock grants, and the company automatically sells a portion to pay the IRS. It's standard compensation. It represents zero lack of faith. Talluri himself still holds over 2.2 million shares. His net worth is tied to this working.
Perhaps, but let's make this real. Let's run the simulation. Say someone has $5,000. They buy in at Friday's close of $662. That gets them roughly 755 shares. Walk me through the dream scenario.
Well, it's not a dream. It's just a re-rating to fair value. If ENVX hits the consensus analyst target of $17.50 over the next, say, 12 to 18 months, your $5,000 becomes $13,212. That's a 164% return.
That is substantial.
But that's just the midterm. If you believe the DCF intrinsic value models, which, assume they actually hit their cash flow targets, the stock should be trading at $33.30. That turns your $5,000 into over $25,000. That's a 5x. That's the asymmetry I'm talking about.
Okay, now let me paint the nightmare. The low analyst target is $7, which is basically where we are. But the real floor isn't zero. The floor is dilution. They aren't expected to be profitable until late 2028. That's 2 full years of burning cash. If Fab 2 hiccups, even for a single quarter, they will have to issue more shares. Your 755 shares will represent a smaller and smaller slice of the company.
They have $648 million in cash as of last quarter. They have a runway.
A runway that runs out. And the volatility is just nauseating. The options market is implying 162% volatility. That means the market expects this stock to swing wildly. You could lose half of your $5,000 in a month if one bad yield report comes out.
Or you could double it. High volatility means high premiums. The analysis mentioned a yield boost strategy, selling covered calls.
Which is sensible, but it's dangerous here. Let's say you buy at $662 and you sell a covered call with a $9 strike price to get some income. Sure, it lowers your cost basis, but if the short squeeze happens, and with 34% short interest, it absolutely could, the stock could rip to 15. You lose your shares at $9. You capped all that massive upside for just a few pennies.
Exactly. That's why, if you believe in the thesis, you hold the shares naked. You endure the volatility because you trust the architecture. You trust that a 38% revenue growth rate is just the warm-up act.
And I say, you demand proof, you wait, you sit on your hands, You miss the first 20% of the move up just to verify that the factory actually works.
And by then, the smart money, the UBSs, the Vanguards, they've already eaten your lunch. They positioned before the good news.
Better to miss lunch than to lose your shirt.
I think we found the line in the sand.
We have.
So to summarize my position, ENVX is a coiled spring. The technology is validated by the sampling with top OEMs. The factory is built, the equipment is there, the valuation is just completely disconnected from the potential of disrupting a trillion-dollar industry. When you have a battery that lasts longer and charges faster, you win. It really is that simple.
And I'll conclude by saying that while the tech is exciting, execution is everything. ENVX is in the death valley right now. Until they prove 90% yield at volume, this stock is a gambling chip, not an investment. The market is skeptical because physics is hard and manufacturing at scale is even harder.
But we can agree on the timeline.
Yes, 2026 is binary.
They either scale and soar or they fail and dilute.
It is going to be a white-knuckle year. Watch those Fab 2 yield updates. That's the only signal that really counts.
If you like this video and want to watch more content like this, then hit the subscribe button. It's totally free. Thanks for watching and see you in the next video.